Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. And it's FedWatch Day. Will it be deja vu all over again? Widely expected, the Federal Open Market Committee implemented a 25 basis point rate cut at the September FOMC meeting, and that brings the new Fed funds trading range down to 4 to 4.25. So with the resumption of rate cuts now officially in the books, the more pertinent question is what will the Fed have in store for the markets for the remainder of this year and, of course, 2026. Remember, it was exactly a year ago Powell and Company embarked on this rate cut cycle and followed their first rate cut in September of 2024 with two more easing moves to finish off the year. The question is, will history repeat itself here in 2025? And that is what inquiring minds want to know. But first up, let's look at the key factor here in the Fed's current decision-making process, namely the labor market backdrop. Although the Fed does focus on their dual mandate of employment and inflation, there's no question the primary focus right now is on the employment side of that equation, especially given the recent stalling out in new job creation. However, at some point, if upcoming jobs data don't deteriorate any further, the policymakers could shift their attention back to an equal weighting with inflation. It's interesting that recent commentary on inflation measures, such as CPI, have been centered on the data coming in as expected, but the underlying data coming in as expected have shown that the spring bout of disinflation is now over and that price pressures are now grinding higher. In fact, core CPI is running at an annual rate of 3.1%, the highest reading since February, and moving further away from the Fed's target at 2%. For the record, the Fed's preferred inflation measure, core PCE, is also moving further away from target at 2.9%. So back to where the Fed may be headed in the months ahead, there's no doubt the tilt will be for further rate cuts, as the voting members have consistently stated that prior to this latest easing move, monetary policy had been modestly or mildly restrictive. And based upon economic data at this point, there doesn't seem to be a need to go into an accommodative phase for policy just yet, but perhaps just get back to neutral. So what is neutral in terms of the Fed funds rate? That's the key question, right, going forward. If you believe it lies in the area of 3.5%, then investors could expect to see two additional quarter-point rate cuts forthcoming. And two more rate cuts could come at each of the remaining FOMC meetings this year, or perhaps Powell and Company may want to take a more deliberate approach and utilize an every other meeting approach to wait out this labor market and inflation data. But the bottom line is, with Fed policy remaining highly data dependent at this stage of the game, getting policy to neutral is a good starting point. If the upcoming employment data don't improve or get worse in the months ahead, the voting members will more than likely front load their rate cuts and get them in before year end, then on to 2026. So that's it for me. Hope everyone has a great rest of the week and be well.